Welcome to Integrated Insights with ICCG. For more than 30 years, our team has partnered with small business owners to prepare for and navigate the business transaction process. Pull up a chair as we share stories and insights from our experience on all sides of the M&A table. All right, and welcome back to another podcast episode. My name is Michael Hefner. I will be your host again today. I am joined by Grant McQuilkin, one of the founders of ICCG. Hi, Grant.
Good morning, Michael.
Morning. So today we're going to be revisiting the topic of working capital. So if you missed them, we did do a couple previous episodes on working capital, both what it looks like in business as well as working capital in action and what it can look like in a deal. But we have a lot of business owners that even after those explanations, they still come and they just have additional questions. So today on this episode, I'm going to do a little bit of role playing. I'm going to be that business owner that still has some more questions. I'm going to be directing them to Grant. So Grant, to get started, I've worked really hard. Right? I've built up my AR. I've earned that AR. I hear you saying that I don't get to keep that. Can I just pay the accounts payable and keep that AR that I've built up?
Yeah, sure, you can, but you have to be careful what you ask for, because, you don't have any leverage. So let's just say you sell your business and now you're going to go start collecting that accounts receivable. Typically one of the factors that you can use when you are collecting your accounts receivable is you can just stop working for that customer until they pay. But in this case, you've already sold the business. The buyer is going to continue working for that customer and is going to get paid on time because they don't want him to stop serving them. And so you lose all your leverage. It's not like you can sue for it because it's going to probably cost you as much to get that accounts receivable paid as it does to sue. So, also, the buyer doesn't want you to control that relationship with his now relationship, right? And so he doesn't want you to go cuss them out for not paying their bill. He wants to, run that relationship. And we've seen hybrids. We've seen to where the seller insists on getting that money and wants to pay all of the bills. And so the working capital sort of normal process is kind of, especially in smaller deals, it's kind of cut off because the sellers or the buyers don't really understand it. And so what we do is we have the buyer actually collect the funds. And as long as they collect the funds, then they transfer maybe a large percentage or sometimes all of it over to the seller. The danger with that is if I'm the buyer, I'm going to my customer and saying, hey, I'll give you, 60% off of your past bills if you commit to buying X amount over the next year, right? I mean, you just lose control. And so it's just, that's why we have our process of making sure it's fair to where neither the buyer nor the seller can rig the process to their benefit. That's why we do that. And, working capital is an asset of the business that you're selling. That's kind of like saying, well, I'm going to sell the business, but I'm going to exclude all of the equipment. Well, how in the world is somebody going to run the business without the equipment that's necessary to run it? And so you've got so many, analogies we've used in the past. We like the analogy of the car. When you buy a car and it doesn't have any tires, you got to go buy tires and then use the car. So when you buy the car, you're going to pay less for the car than you would have if there were tires on the car. And so the point is working capital, a measure of working capital is one of the assets in the business that you purchased for a particular price based on the value of that business, including the equipment, but including also a reasonable level of working capital that generally allows the buyer to not have to invest more money in the business after he's paid you the purchase price.
Yeah. Yeah. Yeah, that's great. I like that you quickly brought in the customer into the conversation, right? Because that's really what it all comes down to. Because if they get to keep the AR, that's not just money they get to keep, right? It still has to be collected. So the buyer could just not collect it. So it's like, hey, sure, you can have the AR, but you're not going to get paid almost any of it, right? And on the flip side, it's just not fair for them to go and quick collect, right, and mistreat those customers and then lose them all. So that's great. Makes a lot of sense. So you just talked about the car analogy again that we brought up previously. So the tires on that car or the gas can be seen as inventory, right? So the buyers that or business owners that have that inventory that's been built up, but they haven't been accounting for it. So if I've built up my inventory, how do I get credit for that?
Yeah, you don't unless you have accounted for it, right? And so there's various different kinds of inventory, right? So we often see this as supplies. And the reason why is because your small to medium-sized businesses out there, they don't want to tell the IRS they have inventory. The reason why they don't want to tell them an inventory is because they don't want to be accrual basis taxpayers. And so all that to say, sometimes there's a level of supplies that are there. It's just not on the financial statements or tax returns for tax purposes. And so it's what is called de minimis. It's only a little bit, but $100,000 worth of supplies is not, it's worth trying to get reimbursed for that $100,000. And so the idea is to make sure that you get to that real quick in your conversations with a potential buyer. You don't want any surprises in the last minute. All of a sudden you do this, working capital calculation has $100,000 worth of supplies on it. I think the other side to it is that, some inventory is, what you manufacture. And so typically if you're doing that, there is inventory that is kind of in the process of being made. And I would say most of your small to medium-sized businesses don't have the sophistication in the accounting system to calculate that correctly. Sometimes they'll do the materials cost, but the labor is kind of complex. And so they don't capitalize labor. I think that is something also that is important for the advisor to understand so that you deal with that upfront with a potential buyer. Because if it's a buyer that is sophisticated, they'll understand. They'll just have to recast those financial statements going back a little bit in order to know exactly how that work in process affects the bottom line. I think, we've faced a lot of issues with long-term construction contracts. So those are really difficult because it's not just work in process inventory, but there's a percentage completion calculation that not only gives you work in process, but it also makes you recognize a little bit of income as you go along in the long-term contract. And so that involves estimates that if you don't give time after the deal is closed to validate those estimates, there's been some lawsuits funded through a manipulation of those estimates, and that all kind of goes into sort of an inventory, but more in a construction contract.
Yeah. That's great. And as far as the working capital and getting compensated for that 100,000, like you talked about, that's talking about like excess working capital, right? 100,000 more than what you needed.
Yeah, but a lot of times there's $100,000 worth of supplies and it's never been part of the financial statements. It's just been written off as they maintain it. And a lot of times it's like you buy it one time and then you just replacing because you're using the same supplies. Think of a medical facility. It's just $100,000 worth of, medical supplies. And so, they order as they use, so to speak, but they're just expensing it at the time. They're not capitalizing it on the balance sheet. So it doesn't look like working capital, but it certainly is.
That's great. So what about cash? So if cash goes into the working capital calculation, why don't I just wipe out my bank account right before I close? Can I do that?
Yeah, most of our deals are, they say on an LOI, it's a cashless asset purchase, let's say. But this assumes that you have an acceptable level of working capital, right? So let's just say you have, $5 million of accounts receivable, but $3 million is from one particular customer. And this is an actual example that we had a few years ago. And right before closing, he collected that $3 million. And so the estimated working capital was deficient at closing. And so he had to contribute cash to the equation. This all just goes into the calculation of what we have talked through in other videos or other podcasts sessions about the working capital peg. And so the other side is obviously if there's a stock purchase, the bank account goes to the buyer, whether there's $1 in it or whether there's millions of dollars in it, it goes to the buyer because it belongs to the corporation. And so if you are buying stock, if you're selling stock, sometimes there's a way to get that cash out of there. But a lot of times it's just additional proceeds for excess working capital at closing. If you're buying assets, the bank account is not yours typically because it's a cashless purchase. And so, obviously there's the cutoffs are really easy. The bank account remains the seller's. But even in a stock deal, we recently did a stock deal and the buyer just opened up a new bank account in the name of the company just to keep the funds separate because it needs to be a clean cutoff, so to speak.
Yeah, that's great. Okay, so what about timing? Help me to wrap my head around. Is this something, do I get paid for any excess working capital right at closing? Is that going to happen later? Does the buyer have to get their eyes on it first? How does that all work?
Yeah, this is how we make it fair, right? So there's an estimate at closing, and sometimes it's a little bit paid, on how the estimate at closing exceeds the working capital peg or the amount that we agreed on in the agreement. Sometimes, as we just talked about, the seller has to leave cash in the bank because it's insufficient. But generally, what happens is the buyer goes in then and has 60 to 90 days to figure out what it actually was. And then you kind of settle up. Some people call it a true up where people get paid. There's some, and so then there's a 30-day, review that both parties get to do. If they don't agree, then it goes to a CPA firm to make sure that they know what is. There's always a technique that lawyers will put in there to make it to where you can agree to the formulas. But, there are exceptions. We just talked about construction accounting. A lot of times contracts have retainage, which you're not going to get that retainage maybe for another 6 months to a year. And so that part of it sometimes is only paid when you actually receive that retainage. And so the buyer is not out of pocket for 6 months to a year to collect that accounts receivable. Typically, the accounts receivable that is normally in that working capital calculation is 90 days or less old.
Well, Grant, you've answered a lot of my questions, but this is still just feeling really over my head. I'm a business owner again. What do I do now? What do I do if I'm just still not getting it after all these questions?
Yeah, I just tell you, a lot of people use different people to help them sell a business or I guess buy a business. And they might be really good negotiators. They might be really good at finding a buyer, those kinds of things. But this part of M&A really requires your advisor to understand accounting and understand how your system can yield data that will help the buyer and seller agree ahead of time, give the buyer a heads up on what is not currently on the interim financial statements. And you have to manage the expectations of buyers early and clearly. And so, that's why I think we deal with financial statements right from the off, right? You yourself, you come to the table, our clients, prospective clients even, will give us financial statements, and you will put them in a format, analyze them so that we have a heads up on, what's missing maybe, and then we ask questions. And that leads to our ability to advise our clients accordingly.
That's super helpful. Well, like Grant said, if y'all have any questions, we'd love to sit down with y'all, help any way we can, especially if you don't have a trusted advisor that's already helping in this arena. But that's all the time that we have for today. Grant, thanks for joining me. And that wraps up another episode of Integrated Insights with ICCG. Be sure to subscribe and stay tuned for more stories from our team. We love hearing from our listeners. If you have any questions or topics you'd like us to cover, please send us an email in the show notes. For more information about ICCG, please check us out on our website or follow us on LinkedIn and YouTube. Until next time, there's always a seat at our table.